Okay. So now let's try to understand our total debt to total asset ratio or total debt ratio. Basically, this simply says that what are your total liabilities, total debts, and compared to that, what are your total assets. So for that, let's go above and see our balance sheet and P&L, which we have originally in detail. So here, if we go and see our assets, we are having our current assets of 250 and our other fixed assets here as multiple items, but overall our total assets are $520,000. Now if we go here and see our total liabilities, so we are having 250,000 of liabilities, which consist of current liabilities of $100 and long term liabilities of $150, making it to $250. So $250 of liabilities, $520 of assets. So if we go below and try to see the impact, so it will be here that our total liabilities is 250 and our total assets is 520, and if we solve that we get 0.5 times. What does it simply means that whenever we are having the asset for $1, we are having the liabilities for $0.5. It means it's a good thing for us because we are having higher assets and compared to that lower liabilities. Now, why does the companies use it? Firstly, they use it to check the risk assessment, if the company is over leveraged, if the company is having higher debt or not. It also checks the financial health of the company, if the company can survive downturns. Because if this ratio changes from 0.5 to 2 by 1, which means if the company is having total assets of $1 and total liabilities of $2, this is a riskier situation. It also helps the companies to compare across industries how they are performing, and finally this can be used for credit decisions as well. Now the real world companies use, just like Microsoft uses it, and Microsoft debt ratio is low because they have taken lower debt. Microsoft finances mostly its assets from equity and retained earnings. So whatever equity shareholders are there or whatever retained earnings are there, Microsoft primarily earns from that, or instead of earning, refinances its projects from that only. This shows stronger financial stability and low reliance on debt. So dependency on debt is very low. If you see the Delta Airlines company, they have a very high debt, around 0.8 times. Why this happens? Because airline companies are required to borrow heavy amounts for aircraft purchase and their operations, because these are heavily money investment required. So they have high debt ratio. Investors accept this high ratio in this sector because these are asset heavy, so investors are good with that. If you see the example for JP Morgan Chase and Company, which is in banking sector, they also have a debt ratio of around 0.9, which means that banks operate almost entirely with borrowed fund, because the money which you deposit in bank, that becomes borrowing for the bank, right? So you can see the deposits become liabilities for the bank, and this high ratios are normal and sustained within this industry.